Right, good afternoon, everybody. I think we'll get going. For those who might not have attended one of our webinars before, my name is Matt Hodgson. I'm a partner based in our Manchester office. Today is the first of our series of 6 webinars that we will be providing between January and June, covering our sort of major service lines. We've gone for a very relevant one in January in relation to investor reliefs, something very much front and centre of a lot of people's minds when they're looking at hopefully offsetting income tax liabilities for this current period. In terms of housekeepings, thankfully not a lot, because it's obviously just a virtual call, but in terms of Q&A, we would just ask, you can submit questions, please do so as the presentation proceeds. And we'll be taking, Sonia and Jack will be taking Q&A at the end. In terms of the agenda for today, I'll be leaving Sonia and Jack to make their own introductions. Jack will be covering the background to the investor relief landscape in general, following which Jack will also continue to talk about the reliefs for the investor in relation to the various venture capital reliefs, and also the benefits for the company of receiving such investment. Following that, Sonia, and this will take up a large part of the presentation, given the actual subject matter is around the qualifying conditions that need to be met in relation to gaining the valuable income tax and capital gains tax reliefs for these particular reliefs. And also Sonia and Jack will then be taking the final part of the presentation, which is the process that both the investors and the companies need to go through in order to qualify for the reliefs. Something we see time and time again, unfortunately, not done particularly well, and can harm those valuable tax reliefs further down the line. And then finally, as I mentioned at the outset, both Sonia and Jack will be taking questions as well. And as usual, we will be circulating a recording and the slides themselves for anybody who's either missed the call, or if you want to, provide it to colleagues, or indeed watch it again if all the detail doesn't go in today. So without further ado, I will pass over to both Sonia and Jack to make their introductions.
Thanks, Matt. Much appreciated. So I'm Sonia Hans. I'm one of the associate partners here at Claritas. I advise clients on various tax matters, and one of which is venture capital schemes, which I actually head up the offering for within Claritas for this service line. I'll pass you over to Jack.
Yeah, hi everyone, my name's Jack. So I'm one of the tax managers here at Claritas. So similar to Sonia, I work across sort of a broad range of our service lines, dealing with sort of various different taxes, but a lot of my focus is on advising our clients on venture capital schemes, typically sort of working alongside Sonia.
And before we start, there's not often in my career I've ever, or I can't recall a time I've ever needed to pull rank before. However, last Friday, Jack's smiling, last Friday when asked who was having the clicker today, I just shouted at me. So I am the one to blame if we go too far ahead on the slides, but we'll try and keep it succinct. So we thought we'd start with a quick poll, and really just to understand, the audience that's here today, and in what capacity you're actually joining this presentation. So really to understand the nature of that. Now, there is a QR code at the bottom. Hopefully you've got your phones to the ready. If you could just scan the QR code and answer whether you're here today as an investor, as a company seeking investment, advising on the equity raise, advising on tax relief, or preparing the legal documentation. If you're an other, I can't think of another that would be here today, but if you are, then feel free to just not respond if that's your preference. I think we'll wait and give chance for people to fill sort of the poll in, but basically the reason really, and you'll find this as we go through the presentation today, is that actually every single one of these different areas is actually fundamental in obtaining the investment, but then securing the tax relief subsequently. And everybody has their own sort of important part to play in that role. I'm not sure if the slides, the outcomes in yet.
Hi, Sonia. Yes, so you have 38% of people are an investor, 13% advising on equity raise, and 25% advising on tax relief, and 25% preparing the legal documentation.
Wonderful, that's great. So a bit of a mix, except for no company seeking investment by the sounds of it, or at least not on the live webinar anyway. So without further ado, we'll carry on then. So we'll start with the background, and I'll pass you over to Jack for this.
Yeah, cheers, Sonia. So yeah, just going to get sort of webinar started with a bit of background, which a lot of you might sort of know, but just sort of set the scene. So in terms of what these schemes are, they are all tax advantaged HMRC approved investor share schemes. So typically, almost always, they're going to be for sort of high risk investments, high risk companies. So that's the sort of main principle behind these schemes, is you get the tax relief, but as an investor, you're potentially taking quite a big risk. So they're principally aimed at wealthy investors, or those kind of investors that have a bit more appetite for risk. And what they do is they provide various different forms of tax relief if you make investments into what are known as qualifying companies. And Sonia will talk a lot more detail about qualifying companies a bit later on. So at the moment, there's 3 schemes that are in place. So there's the EIS scheme. Enterprise Investment Scheme came into place in 1994 when this sort of umbrella of venture capital relief tax legislation came in. Then a year later, they introduced VCT, and then about 10 years or so ago, SEIS came in, which is Seed Enterprise Investment Scheme. So we're going to focus this webinar mostly on the first one, the third one, mainly because they're the ones that we sort of see the most. I expect you guys will see the most too, because venture capital trusts are slightly different, sort of unique type of investment. And rather than investing in the underlying shares, like with EIS and SEIS, you're investing in sort of a company or a trust that owns shares in a whole sort of portfolio. And so it's a lot less risky in that sense. And so the tax relief isn't always quite as good. So yeah, we'll focus mainly on sort of EIS and SEIS. So jumping into why investors want to get involved, what's the benefit, the tax relief for them. I'll go through each one in turn, EIS, SEIS and VCT, and just show you the different benefits. So each of the schemes have broadly sort of 3 categories of tax relief. They've got the income tax relief on investment, the capital gains tax relief when you sell your shares, and also if you sell your shares, unfortunately, at a loss, there's separate loss relief as well for tax purposes. So if you make an investment under EIS, you can claim up to 30% tax reduction. And you can either claim that against your tax bill in the year you make the investment, or you can actually carry it back to the previous tax year. And there are certain instances where it might be more advantageous to actually carry it back if you want to sort of maximize your release, for example. But as with all of these schemes, they're sort of medium to long-term investments. So they all come with a holding period condition, which for EIS is 3 years. So to get that tax relief, to make sure it's not clawed back, you've got to hold your shares for at least 3 years in this case. Then you've got your CGT exemptions or your CGT reliefs. So if you hold onto your shares long enough and then you sell them at a gain, that gain is completely exempt. And you've also got something which is called reinvestment relief. So if you made a separate gain at a period of time, and then you reinvest some or all of those proceeds into qualifying EIS shares, you can claim what's called reinvestment relief. And what that allows you to do is defer your gain up to some point in the future, effectively freezing it for a period of time. And then it will crystallize at some point in the future, typically when you sell your shares, and then that gain will become chargeable. So it's not an exemption from tax, but it does allow you to defer potentially quite a sizable gain, a period of time. And then last but not least, you've got loss relief. So if unfortunately you sell your shares and you make a loss of some kind, it's one of those rare occasions where in the tax legislation, you can actually offset a capital loss against income. You can't offset the full loss if you've claimed income tax relief, because the loss gets reduced by whatever tax relief you've claimed, but it's still substantial. The only sort of catch or thing to be aware of is a loss is a crystallization event for EIS purposes. So if you make a loss, that will sort of crystallize any gain that's been deferred under reinvestment relief. So that's EIS. SEIS, very, very similar, just some sort of slight tweaks to the sort of rates. So instead of 30%, it's 50%. So it's much more tax efficient, much more attractive, because SEIS are typically more high risk companies. They're typically smaller companies. Again, you can claim that tax relief in the current year, previous year. And again, same rules about the clawback. The holding period is 3 years for SEIS as well. CGT, again, similar. You get an exemption if you sell your shares again, if you've held on to them for long enough. And it also has reinvestment relief, but this works slightly differently, because instead of deferring a gain, it actually exempts 50% of a gain. So if you invested 100K, for example, or reinvested, sorry, you could get an exemption on £50,000 of that gain. And then loss relief, exactly the same principle. If you have a loss, offset it against income. It's only the net cost that can be offset. But the special little sort of benefit or quirk with SEIS is if you did use reinvestment relief and you've got this exempt gain, say of 50k sitting there, if your SEIS shares are sold for nothing, which would be very unfortunate, but if they are, that gain never comes back into charge. It remains exempt, forever. So that's a benefit. And then lastly, VCT. So again, we'll just sort of touch on this now and then probably won't talk about it sort of too much going forward. So 30% tax relief. You can't claim it in the previous year, but you can in the current year. Exactly the same rules about the income tax relief withdrawal, but a specific benefit is that dividends are exempt up to the first 200k that's been invested. And that's something you don't get with EIS and SEIS investments, so that's a specific benefit. And then CGT, similar again, you've got your CGT exemption, but the quirk with VCT is there's no sort of ownership period, it's always exempt, but there's no reinvestment relief, and there's also no capital loss relief. So VCT shares are, you can think of them as sort of exempt assets. Gains are always exempt, but losses are never allowable. And that's, I think, broadly because they're seen as sort of reduced risk. So the tax relief in that sense isn't as beneficial. So I thought it'd just be sort of a good idea to kind of run through a bit of an example to sort of bring this to life a little bit. So let's say under the EIS scheme, there's an investor who invests 100k. So they've made that initial capital risk. They can then immediately think about two things. The first one is they can claim income tax relief up to 30%, so that's £30,000. They can also think about if it's possible to make that gain under reinvestment relief. So if they've sold some of the shares or sold a painting, made a gain, they could potentially defer some or all of that to a point in the future. And then let's say in this example, skip forward 4 years, they've sold their shares for 300,000, so they've made a £200,000 gain. As long as they've met all the holding conditions along the way, then that 200,000 is completely exempt from capital gains tax. So that's potentially a £40,000 tax saving on top of the 30,000 they saved when they made the initial investment. So it's a very attractive relief. Second scenario is exactly the same thing, but imagine in this time, unfortunately, 4 years down the line or 5 years down the line, the company's made a loss. So again, you claim your income tax relief, potentially reinvestment relief, but this time you've effectively deemed to sell your shares for nothing, for nil consideration. So you've got that £100,000 capital loss that's sitting there, and you can offset, in this case, 70,000 of it against income in the previous or in the current tax year, which means for a 45% taxpayer, that's £31,500 tax saving. So it shows that even in sort of a worst case scenario, if you made £100,000 investment, you'd get £30,000 back immediately from your income tax, and then another £31,500 when you sold it. So you're actually only investing in the region of sort of 40,000. So for that reason, it's the rewards are very, very high, and although the risk is very, very high, the potential loss is much less than a standard investment. But the one little caveat, obviously, with EIS is if you do have a loss, that crystallizes anything that's been deferred under reinvestment relief. So then we just included this table. This is largely sort of for your illustrative purposes, when you come to get in the slide decks. We've talked about most of these, but one thing I've not mentioned, which I've just highlighted there, is around the conditions about maximum investment. So every investor has got sort of a cap on the amount that they can invest in a given tax year under a given scheme. So for EIS, it's quite sort of broad. So you can invest up to £1 million in a tax year. It can be increased in certain conditions, which I think Sonia will touch on later. SEIS is much smaller companies typically and more attractive tax relief. So the amount you can invest is less. So it's 200,000. And VCT is exactly the same. It's up to 200,000 in any tax year. And I think quite a lot of those have actually increased sort of over the years. Like SEIS, for example, used to be 100. So that's everything from the sort of investor side about why investors might want to get involved. So just sort of quickly brushing on the why a company might want to get involved, why it's beneficial to have these schemes, to offer these schemes to investors. So it gives them access to sort of three things broadly: a wider range of investors that they may have not otherwise been able to have access to at that sort of time in their business cycle. Also, potentially investors who can provide expertise. We've seen a few examples where certain investors not only want to give their monetary benefits, the funds, but they also bring with them industry expertise that they can use to help the company grow. And then lastly, it's a really good sort of funding opportunity for startups to accelerate their growth and potentially get access to investment that they may otherwise struggle or find difficult to achieve. And then the last point on this is with all these schemes, it's worth noting that they're not just sort of a one-off, or they don't have to be a one-off. You could do multiple rounds under one scheme, or you could even do multiple rounds in a different scheme. So it's sort of reasonably common, for example, for a company to do a scheme, offer shares under SEIS when they're really, really small. They maybe just started, they're a startup. And then further down the line, maybe they don't meet those conditions anymore. So they might move up and they might do a round of funding under the EIS scheme. That's quite sort of common. And you can sort of mix and match the schemes provided the conditions are met. And that's both on the company side and also on the investor side. So that's got the kind of first bit about the investor and companies. And I'll pass you over to Sonia to go through all the qualifying conditions.
Thanks, Jack. So Jack's been through all the benefits and what I refer to as the positive side to venture capital schemes. So I now get the opportunity to go through the qualifying conditions that need to be met and what I like to refer to as the more tricky side of the schemes themselves. So if we run through them, so we start with the qualifying conditions that they fall into three main areas. So there's the company conditions, there's the investor conditions, and then there's what we refer to as general conditions, which predominantly is the cash and share conditions. I think it's important to say that we're only covering some of the conditions today because there are lots. And every single scenario that I've ever had to look at genuinely has its own nuances. So you need to look at each one carefully. It's also important to note that the legislation is very prescriptive, and it's really important that if you fail a condition and then the investment has been made, or the investment is made and you subsequently fail a condition, that either there'll be no income tax relief originally, or you may actually have the income tax relief that you've claimed as an investor clawed back by HMRC together with interest on that as well. It's also important to note that often when an error or something has happened which means that the relief is lost, it cannot be rectified afterwards. So in going through the conditions now, it's kind of hopefully going to flag up some thoughts to you as to things to be careful about and to seek further advice on before proceeding with changes. So we'll start with the cash and share criteria. So first of all, the cash must be received before the shares are issued, but not too long before. So effectively, if the cash was to be received in the company bank account today, then we would advise that the shares were issued tomorrow. Not today, tomorrow. That clearly shows that evidence that the cash was received first. But at the same time, sometimes when you have several investors, they don't all pay the money in on the exact same date. So you need to have a spell of time for people to get the money in, for it to clear in the bank account before issuing the shares to various investors. In which case, then don't hold that money within the company for too long. So typically we say a couple of weeks is fine. Leaving it a month, 2 months, 3 months starts to feel as if there's a potential that HMRC could argue that actually that money isn't for an equity investment, it's actually for a loan, and therefore you wouldn't qualify for the relief. So just be mindful of that. Documentation is essential. So I've talked about the fact that you get the cash in first before issuing the shares. So HMRC can ask and do ask to see company bank statements. I've seen this several times. They will ask to see them, and they will note the date that the cash came into the company and was cleared, and also whether it went into the company that was issuing the shares. It's also important to keep the funds in a separate bank account. So we'll talk about it a bit later on in the presentation, but ultimately you need to have spent the money within a required time frame. So for EIS, that is, the money needs to be spent within or needs to be sort of spent within the 2 years, and for SEIS it's within 3 years. But unless you've got it in a separate bank account, it's very difficult to say whether that money has been spent within that time frame and whether it's been spent on a qualifying activity or not. If you've got it all lumped in with your trading accounts, it becomes near impossible, if not definitely impossible, to evidence that at a later date if asked. So then we go on to the company conditions. The share conditions. So I knew I shouldn't have had the clicker. So the share conditions. So the share rights. So the shares must be newly issued, so they cannot be transferred. So if you've got one shareholder, they can't transfer their shares to another person for cash, and that person wouldn't then be able to claim EIS or SEIS tax relief on it. It needs to be newly issued from the company. They need to be ordinary shares. They cannot carry any present or future preferential right to dividends or assets on a winding up, and that's really important. However, they can have a preference on a sale. So, and then finally, they can't have present or future rights to be redeemed on those shares. So they're quite fundamental parts of things within the share rights that are normally covered off or should be covered off in a company's articles of association. So the company conditions. So to begin with, we need to have a qualifying activity. So a qualifying activity is effectively not an excluded activity. Excluded activities, there is a list of them and there are several, but basically they are low risk activities. So things such as dealing in land, something that isn't deemed to carry that significant risk which is required for this relief. There's an age condition. So for this, for SEIS, the trade needs to be less than 3 years old. Now, when we say less than 3 years old, it is the trade on this occasion, not the age of the company. So if you had a company that had a particular trade and then you set up a new company and you transferred the trade in, you are looking from when that trade started in that first company, not the age of the new company you've just created. In addition, for EIS and VCT, the age condition is that the company must be less than 7 years from its first commercial sale date. There are some exceptions to this, so I'll run through those. So the exceptions to the 7-year rule is that if you are what's referred to, and Jack's already mentioned, knowledge intensive companies. So if you meet the knowledge intensive company criteria, effectively that 7 years becomes 10 years. And instead of being from the first commercial sale, it's from the end of the accounting period in which you first turned over £200,000, which is a bit of a mouthful in all honesty. But effectively what that means is your 7 years could potentially be 12 years, for example. So it's really critical to, if you're outside of the 7 years and you're looking for reliefs, to still actually consider whether you meet one of the exceptions. The next exception is what's referred to as follow-on funding. And effectively, this is where you've been able to claim the venture capital scheme tax relief in the past, so SEIS, EIS, VCT within your company, and you've made that claim. This is effectively saying that you need some further funds to do the same thing. But at that stage, on this further funds, you're outside of the 7 years. As long as you made that original claim within 7 years, you can still qualify. There is also some things around business plans, but we'll talk about that later on. The next one is new markets, geographical or product. Put a question mark because I think people generally seem to think that you just need a new product or a new market, and it's definitely or a new geographical area, and it definitely is not that. It needs to be a completely new market. Effectively, you can't rely on what you already know or have established. So effectively on the geographical front, say you currently work in, or the company trades in France and you're looking to move to Germany, then strictly is that really that much of a difference on the geographical market? It may be, but it may not be as well, even though it's a different location. However, if you're in France and you're looking to move to China, then that may be a very different sort of geographical location, a very different set of issues and things that you need to overcome to be able to trade over there. So it becomes starting to feel more like it would meet that new market condition. And then there's follow-on funding for a previous new market. So if you've got your new market and then you need additional funding, you can still go for that afterwards once you've got your new market funding in. So the use of funds, they have to be to grow the business. The government are giving investors valuable tax relief, but they're giving them this relief and opportunity because they want the economy to grow. So it needs to be to grow the business. So that means it can't be for working capital or to buy another business that's already in operation. So by that, what we mean is if you've got an employee, say your company's already been going for a year or two, and you've already got 3 employees, you can't get the relief in to pay for those 3 employees because they're already committed expenditure and you're effectively just keeping the status quo going. What it can be for, though, is new employees. So new employees for marketing or new employees to develop an IT software system or such like, but it is for growing that business. And it also must be used within the required time frame. So I've already said that required time frame is for SEIS is to be spent within 3 years. For EIS, it is actually employed within 2 years. However, the definition of employed is, as with a lot of things with tax legislation, is not defined. and therefore we do recommend that you work on the fact that it is spent within 2 years. And then there's a risk to capital. There needs to be a significant risk to capital for these investments. As I've said, and as Jack's already run through, there is valuable tax reliefs out there, but it's because those investors are putting their money in and because it is risky. So there has to be a risk to the capital that they're putting in. So further conditions is the ownership of the company. So it cannot be controlled by another company. So control or have arrangements to be controlled by another company. Also, it can't have subsidiaries that aren't more than that aren't 51% subsidiaries or controlled subsidiaries. So all subsidiaries must be controlled by that issuing company. So that basically is anything a subsidiary over 50% is fine, which therefore means that joint ventures can cause an issue. Again, if you are looking at having a joint venture within the group, definitely look at it. If you're an investor and there's a group with a joint venture in it, make sure it's looked at, because it could actually disqualify the investment from qualifying for the relief. And also, if you've got a top company, the funds always come into the top co. And if you've got those subsidiaries underneath, they need to be at least 51%, as I've just said. If you actually want to use the funds within one of those subsidiaries, though, it must be at least a 90% subsidiary to use the funds within it. There's a stop sign for a reason. Stop, and I think this is definitely one of those of, whenever you're planning or considering making any changes to a company share structure, whether it currently has SEIS or EIS tax relief investors in it, whether it's proposing to have some investors in it, just take stock, stop, think about what you're planning on doing, and think, could it impact on either current investors or future investors? So, for example, a share buyback can impact relief that's already been obtained or future relief, and that isn't necessarily the share buyback for the person who's claimed EIS or SEIS. So I think people don't always think about it, but be careful on share buybacks. Share for share exchanges, so effectively putting a new company above the company where you've put your investment in. Again, it can work, but there are strict rules and it has to mirror the shareholding, and you also must apply for clearance to HMRC. If you haven't applied for clearance to HMRC, it's deemed as a deemed disposal at the point of the new company coming in. And then there's, changes to any share rights. Have you done something, or are you planning on doing something which could create a preference? So, for example, this could be that you've got EIS shareholders and you decide to put an EMI option scheme in place. And for whatever reason, you decide that those EMI share options, you want them to be over shares that don't qualify for dividends. So if you do that and then the shares are exercised, then all of a sudden you've created a preference for those EIS, SEIS shareholders if they can receive dividends and the EMI shareholders can't. So effectively, again, doing things with any of the shares, whether they are ones that have claimed relief in the past or not, could have an impact. Similar to the slide that Jack showed, we think it, a useful summary of the sizes of the companies. So we've talked about the ages for SEIS and EIS and VCT, but there's also a size condition. So SEIS, as we've said, is more valuable relief, but at the same time, it is for those sort of smaller startup companies. So there is like the smaller limit compared to the EIS and VCT, which is significantly greater, as you can see there. And the thing to note is that if you do qualify as a knowledge intensive company, that actually some of those conditions, not just on the age that we've discussed, but also on the size of the company increase. So they're highlighted there. You can have double the amount of employees, twice the amount of annual fundraising per annum, and the actual lifetime fundraising limit also increases. Unfortunately not double, but not far off. So that's the company conditions. So the investor conditions to be mindful of, especially as we have some investors on the call today. So we've got the connection test. So an investor cannot be connected with the company during what's referred to as period A. And period A is from the start of the incorporation date of the company. If it's under EIS rather than SEIS though, and the company is more than 2 years old, then it is just 2 years before the share issue date. And it ends on the termination date which is typically 3 years from when the shares are issued. It can be later if, for example, the company wasn't trading when the shares were issued, and then that would be 3 years from when the trade started. But that termination date is referred to on the certificates that are given to the investor. So then we go on to what's connection. So what is connected? So more than 30% share capital. So this is issued and ordinary share capital. It's also, you can't have more than 30% of the voting rights, which is really important if you've got shares which have got non-voting on them. So for argument's sake, say you've got exactly 30% of the issued and ordinary share capital, but there are some shares that have non-voting on them, then ultimately you'll have more than 30% of the voting rights, and therefore you wouldn't qualify. You'd be treated as connected. An employee is also connected unless they're also a director, in which case the director status overrides the employee status. And therefore, as a director, you may be able to claim relief. Generally speaking, again, there are specific rules, but generally speaking for SEIS, if you're unpaid or your remuneration is deemed reasonable, then you can qualify for the relief for SEIS. For EIS, generally speaking, it's unpaid. So again, you can be a director as long as you're an unpaid director, but again, there are some exceptions to that. Associates, so included in that connection test and that 30%, and whether you're classed as an employee or director, you need to include not just yourself but your associates. So your associates are your spouse, your civil partners, ancestors and lineal descendants. So effectively you're looking up and down the chain of your family. So you're looking at your parents, grandparents, you're looking at children, grandchildren. However, aunts and uncles, brothers and sisters, cousins, they aren't classed as connected for these purposes. You're also connected with business partners. So if you're in a partnership with somebody else and the two of you decide to actually then invest in a separate company under EIS or SEIS, you would need to take the combined total when looking at the tests. And similarly with trusts and personal representatives regarding estates. So the other areas you need to be mindful of are when whether value is actually received. So you're not allowed as an investor to receive value under the period of 12 months before the date of issue to the termination date. So it's really you need to be really careful around dividends. So what we always recommend is that it's included in the Articles of Association that dividends cannot be paid during that period. There's a twofold reason for that. One is, potentially people will forget. So shares get issued, people claim the relief, a company or the investor will forget this condition, and then maybe 2 years down the line, dividends will be declared, in which case you've potentially then lost your tax relief. The other reason is that ultimately, as an investor, I'm sure, in the majority of cases, you don't want other people receiving dividends when you can't. So again, having it built in the articles that it can't be within that time period seems to sort of deal with both of those scenarios. And also loans, we do recommend that, again, if there's any loans between the company and the investors, that you approach with caution. So that's whether the company is loaning to an individual or an associate of an individual. Has that been done on more favourable terms? Or alternatively, if the investor or associate is actually loaning money to the company, are there any repayments that are going to be made from the company to the investor that could actually be deemed as them receiving value, and therefore, again, disqualify them from the relief that they may have already claimed at that stage. So again, just be careful with the loans. So, so we're just going to go through then the process. The process. I must admit, my clicker is not as responsive as it was when we weren't sharing screen, so apologies. So I'll pass you back over to Jack then to run through the process from start to finish.
Cool. Cheers, Sonia. So we sort of talked about obviously the benefits for investors and companies and all the conditions. So I guess the next question now is, how does it sort of look in practice? But just before we do that, we want to throw out another sort of quick poll just to gauge sort of the audience and what your experiences have been with EIS and SEIS. So if you just do the same as you've done before, please just scan that code or use the link and just answer this question, which is just asking what level of involvement you've had in EIS, SEIS before, whether you've sort of been through the whole process, you've done it quite a lot, maybe you've only done it once or twice, or you've done it once, but it was ages ago, or if you're totally new to it and you've never done it before and you're just interested in what the options are and what's available. So yeah, that'd be great. So you should just be able to scan the code, hopefully just the same as the first time, and it should work. Fingers crossed. I'll wait for you, Talia, to let me know roughly what the results are, just so we
So
get.
again, it's quite mixed, Jack. So you have 14% saying yes often. There's 57% saying yes, but only once or twice. And then for the other two responses, both have 14%.
Okay, brilliant. Thanks, Talia. Yeah, so it's a bit of a mix, which is good. So some stuff, some of you guys might be familiar with, and other parts, some of you won't be. So hopefully will be useful. So yeah, in terms of the process, we've sort of broken it down into a 5-step process, which is what they all typically are. And again, just worth saying, obviously, with our jobs and our roles, we're involved in this process from the very, very start all the way to the finish at varying different levels all the way through. But it's something that we've got a great deal of experience with. So in step 1 is the company has the opportunity to go for what's called an advanced assurance. So it's an application which the company makes to HMRC to basically say, at this point in time, we think we meet all of the qualifying conditions for EIS or SEIS, and you're asking HMRC to assure that. It's not a sort of guarantee, but it's an assurance that at a given date, you've met all of the qualifying conditions, and therefore you would be able to then go about offering an EIS or SEIS scheme to potential investors. So I won't touch on it too much right now because Sonia's going to go through that in much more detail because that forms sort of quite a big part of what we do. So Sonia will touch on that in a minute or so. So in step 2, let's say you've done your advanced assurance, HMRC have come back and sort of ticked it all off. Then at that point, the investor will make their investment. And we split this down into 2A and 2B because it's fundamentally important that the investor pays the cash and then they get issued with their new shares in the company. Can't be the other way around, which we've sort of seen it a few times because that can cause a problem. So the investor will pay their money in, and then quickly afterwards, subsequently, they'll get given their shares. They'll have made the investment. And then that leads on to step 3. So at this point, the company is sort of responsible for filing with HMRC what's called an EIS1 or an SEIS1, depending on which scheme. And this is basically a sort of compliance statement form that I think you fill in online, similar to the advanced application form, submitted to HMRC, and it's just stating that at that point in time, when the investment is made, all the qualifying conditions for the company and the investor are met. And it gets filed to HMRC, and sort of fingers crossed, your advanced assurance application and your EIS1 are pretty similar, and it's sort of a bit of a sort of a copy and paste job for a lot of it, except maybe a few small changes that might have happened in the intervening period. Then step 4, you submit it to HMRC. Let's say hopefully they come back and they say yes, they're happy with it. They'll issue what's called an EIS2 or an SEIS2, again, depending on which scheme, which basically is just a very small document that says, yeah, we're happy with the EIS1, etc. And they will also issue what's called an EIS3, the last form, I promise, or an SEIS3, which is blank. And this is the form that the company then needs to fill out on behalf of the investor, hand it to the investor, which they will then use to claim their income tax relief, whether they do that on a separate claim form or typically it will go through their self-assessment tax return at the end of the year. So that's your kind of sort of 5-step process, quite a few forms to fill out. And obviously, in our job, we're involved in it from the very beginning all the way through to the very end at sort of various different degrees, advising both the company on meeting the conditions, filling out the forms, and then also to a later extent the investors as well in terms of claiming their income tax relief. So yes, that's the process. So I'll pass you back over to Sonia to sort of finish up going into more detail about the advanced assurance bit.
Thanks, Jack. So we've just running through then the advanced assurance application. So this is a process now that is done entirely online. It used to be that you would find a link online and fill the form in and print it off and email it, but it is now completely online. The advanced assurance can't be speculative. So by that, HMRC mean you need to have a company formed that's going to be getting the tax relief in. You do need to provide the company number as part of the application. In addition to that, you need to have details of the investors, so their names, their addresses, how much they're likely to be putting in as an investment, what shares they're going to be getting for that, what the share rights are. It effectively, HMRC were getting too many applications through to consider that then didn't materialise into any actual investment. So hence they introduced this a few years ago, that it couldn't be speculative. The advance assurance, now as Jack said, it's a form. As with a lot of forms on HMRC, they're small boxes, so it limits how much information you can provide. So what we always do and always recommend is to attach a detailed covering letter. You need to set out in full what you're planning on doing. So we always set out clearly how the company meets all of the requirements. So we literally go through every single requirement possible and explain how it meets it. If there's any areas which may be contentious, we'll explain why we still feel it meets it. And it's really just the setting out that full position really does minimise the risk. It minimises the risk of delay of a response from HMRC. And we'll talk about the timeframes further on this slide, but it reduces that delay and therefore the timeframe in which the investment can be received by the company. But it also reduces the risk of a subsequent challenge. Now, as Jack said, you complete the advance assurance process online, and HMRC say at that stage whether they're happy that everything from what you've told them, whether the company qualifies for meeting the conditions on that investment. However, if things then change or you didn't provide all the information at that stage, that could end up with HMRC taking a different viewpoint. And when they come to look at the final compliance stage, they could come back with challenges and questions. So again, setting it all out very clearly, very openly from the outset is definitely advisable. When you send the application, there is specific documentation which is required. And I highly recommend, in red, reviewing it before it's sent. So the documents generally that you need to send are a copy of the business plan. You need to send a copy of the cash flow forecasts, a copy of the proposed use of funds, and also various legal documentation. So, for example, when I said review it before it's sent, I have seen cash flow forecasts that don't add up. I've seen cash flow forecasts that don't show this investment coming in and shows that the company's going to grow without the investment and therefore it's not required. I've seen business plans which are in any sort of given scenario, you would expect a business plan to be very positive, but it doesn't then set out the risk and the potential risk to the capital. So again, it's just making sure that does it tick all the boxes? Is there anything that either A, on these documents that need to be reconsidered, or B, whether they need further explanation in that covering letter to get HMRC comfortable on what's being told to them. From the legal documentation perspective, so typically that's the articles of association and investor agreements. Now, again, it's really important that you review the drafts. Typically what happens is there'll be an articles of association for the company that gets sent together with references to changes that are proposed if the advance assurance goes through. So there may be some new share class rights put in place, some new share classes and therefore the rights set out of those. But for example, do the articles of association or what you're proposing put a preference on any of those shares that are going to be issued for EIS or SEIS purposes? Or in respect of investor agreements, have you said on day one they're going to become a director on EIS and be fully paid? Things like that actually would then mean that it doesn't qualify. So again, review all the drafts of any documents before they're sent to HMRC. Be mindful that HMRC may not be quick in their response. So typically, as soon as you send the details over to HMRC, you will get a bounce back and it will tell you that they deal with, I think the current timeframes they quote are 80% of correspondence within 3 weeks and 95% of correspondence within 8 weeks. So, yes, typically you should expect, there's a high probability you'll come through within those 3 weeks. However, if you have any complexities in that claim, or they are just busy in the team, bearing in mind it could be 8 weeks, or you could be in that 5% and it could be longer. I think the other thing to note, as I've said above, is, in setting everything out, you are reducing the risk of HMRC coming back and asking questions on the advance assurance before they get comfortable. If they come back with a question and you answer it, your time starts again. So effectively, you're back to 3 weeks for them to respond, or maybe up to 8 weeks. So, you know, setting it all out to begin with is pretty much essential on the timing, because often people, when they put the advance assurance in, are looking for investment shortly after. So bear that in mind. And also, finally, as Jack said, the SEIS, EIS 1 stage is the factual stage. So advance assurance is what you're planning on doing. EIS 1 and SEIS 1 is what you've actually done. So it's those factual things. So you need to highlight any changes. If things haven't changed, then, you know, no more documents are available or no more sets of accounts have been published, then HMRC, you know, don't want to see the same documents again. However, if there are changes to final documents, such as the final articles of association have now been put through, or the final investor agreements when they were sent drafts, you need to send those as well. So I am conscious there's a lot of information that we've run through. There's a lot in this, and like I said, you know, it is pretty much a whistle stop of some of the key areas as an overview. But in summary, we've talked about the tax reliefs available for investors. I'm clearly not being, there we go. I'm clearly not being forceful enough with my clicking, and I'm being too forceful. It's one or the other. So effectively, we've talked about the tax release for the investors. We've talked about the benefits for the company. We've talked about the qualifying conditions, so both for the company and for the investor and for the shares and the cash. And then we've then gone through the process itself from effectively from start to finish. And as Jack said, you know, we get involved in the process from start to finish, which, you know, we haven't mentioned already, but it does also involve, can involve structuring as well, and considering, you know, if you don't meet the conditions, why don't you meet them? And is there a way that actually, you know, that it can be reconsidered as to the way the investment's received or what it's being used for, that would actually result in it then qualifying for the tax relief. So I think time-wise, we're within our time. So first of all, thank you. And then thank you for obviously attending today, but also asking if you've got any questions at all.
Thanks, Sonia. Thanks, Jack. That was excellent, very informative. We've had a couple of questions through, so I'll go with the first, and you decide who's going to take which. So the first one is, does the investor have to pay stamp duty on the issue of shares?
Yeah, I can answer that one, Matt. Nice sort of answer. Yeah, the answer is no, because with all these schemes, to qualify under one of the share conditions that I think Sonia mentioned, it's got to be newly issued shares, and newly issued shares won't attract stamp duty. So for the investor, they don't have to worry about that tax. It's just all good stuff, all the tax relief.
Very clear, thank you. And then the next one is, can you claim SEIS and EIS tax relief in the same equity raise? If so, how does it work?
Good question. So yes, you can, but you need to be very careful. So for those that have claimed in the past, I'm sure you'll be aware of this already, but you can claim SEIS if you're going to claim in a company both reliefs, whether it's, you know, concurrently or, you know, a year apart or whatever, you have to claim SEIS first. If you claim EIS, you can never go back and claim SEIS. So you have to claim SEIS first. That's really, really important. So the timing of it is imperative. You need to make sure that you've got the cash in from the SEIS investors. You need to have issued the shares for SEIS, which includes updating the register of members so that these shares are officially issued. And then only then can you then get your EIS in. So effectively you could do, say, within a week of each other, so on the same round, but you do need that definite gap, definite space between the two.
Thank you, Sonia. Very good. And then we've got a further question that's just come through, which basically says, are there a minimum number of investors required?
No. So no, so you can literally just have one investor. If one investor is looking to put money in, and we've assisted on several of those where somebody may have 20,000, may have 100,000 or 200,000. And again, if there's one investor, again, that investor can claim SEIS and EIS if you're in a position where you qualify for SEIS, and the amount you're going to put in that equity investment is actually exceeding the limits on SEIS, you can split it so that you get both reliefs.
Excellent. Well, that's all the questions we've got. As I mentioned at the beginning of the webinar, there will obviously be an opportunity for anybody listening to submit further questions by way of response to our email that goes out with the slides and the recording on. So always happy to help, always happy to answer any questions you've got on this subject matter.
Great. I think if it's not too cheeky, Matt, and if people have got a few minutes spare, whether we just run through a couple of case studies, we didn't know whether we'd have time or not. Yeah. So if that's okay, so they will be quite quick, I promise.
Okay.
So 2 case studies that we've been involved in. One was a company that was 12 years old, and they were advised by another party that they would not qualify for the relief because of the age. And they were also told that if they didn't qualify, they wouldn't then get any investment. So we reviewed the position. We confirmed that they met the knowledge intensive company conditions, which are on the slides when we circulate those afterwards. So they met the conditions, they met the extended age condition, so their £200,000 turnover and the 10-year rule with the KIC, submitted advance assurance to HMRC, and then they received and were able to get their £2 million investment that then qualified for EIS tax relief. Again, it was one that I remember an email coming through saying it probably won't, but can you look at this if it qualifies? And it was one that did. Another one that a company that was less than 2 years old that had 500,000 coming in of investment from several people. So we advised to separate the investments. So again, like discussed earlier, having different dates so that they would get SEIS on their initial investment and EIS on subsequent investments. We also advised on the timing of the shareholding so that nobody at any stage went over 30%. Again, that's critical when you're doing different share issue dates, making sure that nobody breaches it at any point. And then we also advised them on other areas. They were looking to spend some of the funds on something that was going to be non-qualifying. So they did have other funds available, and we said keep the funds separate in a separate bank account. So it's very clear, and it can be evidence you've not used those funds for a non-qualifying purpose. So again, that was something that we advised on, and it is literally a from beginning to end process. There's that initial call with the client, literally right up to the stage that the investor's claiming their tax relief. So we're always at the end of a phone call or a Zoom call or a meeting room to run through queries along the way as well. And that was it on the case studies.
They were short and sweet. Thank you, Sonia, but once again, very clear. So, okay, well, once again, thanks to our speakers today, which I really did think that was an excellent presentation. This is by no means a straightforward area, and I think we constantly see questions and investments done incorrectly, you know, leading to real issues further down the line. You know, I've had personal, well, not personal experience, but I've certainly seen somebody have to forego their capital gains exemptions years down the line through just simply not ticking a box, or, you know, not filing the requisite documents, and that can obviously be very costly. So well worth getting advice in this area. As I also mentioned at the beginning, this is the first of a series of 6 webinars. As you can see on this current slide, our next will be on the sort of very timely private client and personal tax arena, coming towards the end of the income tax year as well. So it will be an excellent presentation from Sam on that. You'll be getting further details, as you have done for this webinar as well, as we get closer to the event. So we hope to see you all on that. And once again, thank you very much for your time.